Great. Okay. The stage is yours. Hany Rashawn, portfolio theory. He'll take over. Also, currently, I don't hear anything.
Hello?
Yeah, now we can hear you. The stage is yours.
Let's start. I have 10 minutes and I'll try and give you as much helpful information in that time as possible. So the topic today is basically how to think about cryptos within a modern portfolio. This is oftentimes after the initial, what cryptos should I invest in? How do I get started? How do I learn? Is the immediate next question. And so we get oftentimes people wondering, well, how much is appropriate and how much should I be thinking about putting in to crypto and to my crypto allocation? The first thing that we think about and that we share based on our research is that one shouldn't think about crypto allocations as this monolithic concept. It shouldn't just be about what should my crypto allocations be, because cryptos itself as an asset class is fairly diversified. There are different types of cryptos. These are a bit like comparing apples to apples. Apples to oranges versus apples to apples. And so oftentimes how we really push people is, what do you think the Bitcoin allocation of the portfolio should be, or the Ethereum or smart contracts, blockchain kind of investments of a portfolio should be versus overall? We believe that cryptos as an asset class roughly can be divided into three. Crypto commodities, which is the form of digital gold like Bitcoin, smart contract platforms like Ethereum, but also all the competitors from Binance to Polkadot, Cardano, etc. And then lastly, payment tokens in either stable coins that maybe are generating interest for your treasury, or things like Ripple or Bitcoin Cash or Litecoin that are designed for payments. And so again, oftentimes we believe in if we take a look at just the Bitcoin and Ethereum, is not thinking about payment tokens, not thinking about potentially putting the USD on a company treasury in stable coins that generate high yield versus typical fiat. What we often see is Bitcoin as a store of value, as digital gold, should be most compared to gold. Right now, it represents about 10% of the immediate market value of gold. However, in a portfolio, Bitcoin is often an excellent way of improving the Sharpe ratios, the diversifications, and therefore any risk-adjusted returns. When we've modeled this out, we've done a number of portfolios where the true big impact starts coming in at the 5% mark. Less than 1% allocation to Bitcoin and Ethereum doesn't do too much, but it is the minimum. Anything below that won't even be felt in a portfolio. However, it is on the about 5% mark that we really start seeing that. In addition of as little as 5% would return 29.5% over the last year, compared to a portfolio with 5% gold, which would return 15.5%. That's almost double the amount at 5%. And in addition to that, the correlation is oftentimes, in addition to the positive returns, something that is really, really sold rather well when it comes to crypto asset like Bitcoin and Ethereum. And in our case, what we found from our research is that in the same time period where a portfolio with 5% allocation to Bitcoin would have returned 29.5% over the last 12 months, compared to the 5% of gold, which would have returned only 15.5%, the correlation of Bitcoin with gold is 0.25%. Correlation with Bitcoin and bonds or fixed income is negative 0.11%, and the correlation with stocks is 0.39. And so the correlation overall is actually quite low, which is why you get these asymmetric, uncorrelated risk return adjusted profiles. And overall, this is how we like comparing these assets, is not by judging anything beyond just the normal Bitcoin and Ethereum allocations, but overall looking at these as the premier aspect of investing in the crypto asset class. Not stable coins, not anything like that, but just the Bitcoin and Ethereum. And we find in virtually every portfolio that basically the conclusion of my talk is around 5% is when it starts to really have an impact. The last thing I will do, and I apologize for doing this in such a rushed manner, I had technical difficulties before, is that we also find the data over many years is that investing in both the top crypto assets, in both Ethereum and Bitcoin, actually provides a much higher risk-adjusted year-to-date returns. Not just in investing in one asset or another, but rather investing in both. Because again, the initial first concept that we really like pushing and sharing with people is that this is not a monolithic asset class. Bitcoin may represent a sovereign, non-correlated store of value, a form of digital gold, whereas Ethereum is more like betting on a technology platform. They're different theses that may be built on the same blockchain technology, but have very different applications. So oftentimes, there can sometimes be something that moves Ethereum up or down that actually may have the opposite effect on Bitcoin. And so it's really thinking about both of those in a separate fashion, and indeed separating them from the rest of the crypto asset class. I gave this very quickly, hopefully to leave some times for questions as well in case any have come up. But overall, the conclusion is about 5% is when it starts really mattering according to the data that we see, which is largely consistent with some of the corporate treasury stuff that we've seen from Tesla and others. I think Tesla put about 10% of their total cash into Bitcoin. But with that said, since we only have 3 minutes left, I'll open it up for questions in case anyone has anything to ask.
First off, thank you very much.
Apologies again for doing this in such a rushed manner.
No worries. It's fine. Thank you for the presentation. Currently, there are no questions, which might also be due to technical disruptions, I think. Yeah. So if you have anything to add, you can. If you'd like to use the last 2 minutes. You are free to do so.
I went through the presentation fairly quickly in order to give people questions, so I don't have too much to add. I'm not a fan of taking people's time. Look, overall, we've seen surveys. The Wealth Report Attitude Survey, for example, that showed crypto asset allocations are less than 1% of individuals with over $30 million of investable assets. The proportion of the investments in the crypto asset class are less than 1%. Our data shows that less 1% or lower doesn't have a huge material impact on that portfolio. And so what we think is going to ultimately start happening is people will get closer to this 5% figure. And the differences we see between 1% and 5%, according to the data, not according to our own personal opinion, is pretty large. And so that's where we would predict the world would go.
Okay, great. Thank you. I think what would interest me is you said 1%. How has that developed over time? Was it like in the recent 10 years or more like recently? Is that
very recently?
Growing,
so obviously, even a 0.1% allocation to Bitcoin in 2010 would have made you a very happy man today. But based on what we are seeing over the last 12, 24 months, and based on how large this asset class has become, it's 10% of gold today, for example. Just Bitcoin, more than 1%, less than 10%. And 5% is really where we start seeing material impact.
Okay, great. Thank you very much, Hany.
Thank you.
It was a pleasure having you, even despite the technical troubles.
I apologize again, but pleasure
worries.
was all mine. Thank you, guys.